Ladies and gentlemen, when we talk about wealth in the coming decade, we must think differently. The old formula of public stocks plus bonds plus real estate is being challenged by structural change. Let me walk you through the three assets I believe will dominate the future of wealth. We are living through one of the most profound transformations in capital markets history. The way wealth is built, allocated, and preserved is no longer bound by the frameworks of the past. The traditional 60/40 model, long considered the gold standard of portfolio construction, is being challenged by forces that few could have predicted just a decade ago. Structural shifts in technology, demography, and macroeconomics are redefining risk and reward. As innovation accelerates exponentially, investors who remain anchored to old paradigms will miss the very opportunities that will define the next era of growth and wealth creation. The central driver of this shift is technological innovation, disruptive, exponential, and deflationary by nature. For more than a century, markets rewarded exposure to capital, intensive incremental growth models. Today, we are in a new world, one that rewards agility, scalability, and intelligence. Artificial intelligence, robotics, blockchain, genomic sequencing, and energy storage are converging faster than ever, reshaping entire industries and spawning new ones. Capital is now flowing toward companies and assets that harness this convergence, those positioned not for cyclical rebounds, but for exponential expansion. This evolution demands a rethink of asset allocation at its core. The second catalyst is macroeconomic, the breakdown of traditional correlations. Bonds, once the ballast against equity volatility, have lost much of their defensive character. Decades of artificially suppressed interest rates have distorted risk premiums and inflated valuations, leaving investors vulnerable as monetary regimes normalize. Meanwhile, inflation, though moderated in headline terms, remains structurally unpredictable due to supply chain rewiring, energy transition costs, and geopolitical fragmentation. The result: fixed income assets can no longer be relied upon to preserve purchasing power. That realization alone is forcing investors to look elsewhere, toward private markets, real assets, and innovation-driven sectors that can outpace inflation through productivity gains. There is also a generational element at play. Younger investors, digital natives, are reshaping preferences in capital markets. They value access, transparency, and alignment with technological progress. Their portfolios reflect that mindset: greater exposure to alternative assets, digital instruments, and thematic strategies that reflect long-term secular shifts. This democratization of access is accelerating through tokenization and digital platforms, which enable fractional ownership of assets previously reserved for institutions. The very definition of investable universe is expanding beyond public equities and bonds into private credit, infrastructure, intellectual property, and digital tokens representing real-world value. Another force driving this reallocation is the emerging recognition that innovation is not a niche, it is the economy. Traditional sector distinctions are blurring as technology embeds itself in every value chain. Transportation is becoming software, energy is becoming data, healthcare is becoming information science. In such a landscape, static diversification based on geography or sector is increasingly obsolete. The new diversification principle is one of innovation exposure across platforms, investing in the ecosystems that enable exponential cost declines and productivity growth. These are the engines that will compound returns while deflation from innovation offsets inflationary pressures elsewhere. Institutional capital is beginning to move accordingly. Sovereign wealth funds, endowments, and family offices are increasing allocations to private markets, venture capital, and infrastructure that align with long-term megatrends. This is not speculative enthusiasm, it is strategic necessity. In a world of slower nominal growth and shrinking margins for error, investors must position capital where innovation multiplies output without equivalent input cost. These are assets with asymmetric upside, the ones capable of compounding in both deflationary and inflationary environments. Ultimately, the paradigm shift in asset allocation reflects a deeper recognition. Wealth preservation and wealth creation are no longer the same exercise. In an era of accelerating change, preserving wealth through passive exposure to legacy indices is a form of risk. Creating wealth requires active engagement with the future, an intentional shift toward the assets, technologies, and ideas that are rewriting the economic map. The portfolios that thrive in the next decade will be those constructed not from inertia, but from vision, allocating capital where exponential progress is inevitable and disruption is opportunity in disguise. For decades, the architecture of global finance has been defined by exclusivity. Access to transformative investments, venture capital, private equity, early-stage innovation was reserved for institutions and the ultra-wealthy. Ordinary investors were left at the periphery, confined to public markets long after the most exponential growth had already occurred. But that old structure is breaking apart. A silent revolution is underway, powered by technology, transparency, and decentralization. The democratization of access and the rise of tokenization are rewriting the very foundations of ownership and wealth creation. The driving force behind this change is simple yet profound. Information and access are no longer scarce. Blockchain technology has introduced a new financial language, one where assets can be represented, traded, and verified digitally without intermediaries controlling the gates. What this means is that the barriers to entry, geography, capital requirements, regulatory fragmentation, are collapsing. A real estate asset in London, a solar project in Kenya, or a startup in Singapore can now be owned fractionally by anyone, anywhere. The notion of exclusivity in investing is being replaced by inclusion, transparency, and efficiency. Tokenization is the mechanism making this shift tangible. It transforms illiquid, large-scale assets into divisible, tradable units on digital ledgers. This process unlocks trillions in trapped value assets that were once static and difficult to access, like infrastructure, art, private credit, and intellectual property. Now, through digital tokens, ownership can be distributed across a global base of investors. These tokens represent real economic rights, cash flows, dividends, or appreciation, just like traditional securities, but with frictionless liquidity and near-instant settlement. The implications for capital formation are enormous. Liquidity increases, costs decline, and markets that once operated behind closed doors become transparent and dynamic. More importantly, tokenization is not merely a technical innovation. It is a philosophical one. It challenges the hierarchy of who gets to participate in wealth creation. For generations, financial intermediaries captured the early and most profitable stages of innovation. By the time opportunities reached public markets, much of the exponential growth was gone. Now, technology is redistributing that opportunity curve. Through fractional ownership, even small investors can gain exposure to assets once out of reach: early-stage ventures, private funds, or physical assets. The democratization of finance is not about speculation. It is about access to structural growth. This shift also addresses one of the most persistent inefficiencies in capital markets: liquidity fragmentation. Trillions of dollars are locked in illiquid assets because ownership is cumbersome, transfer costs are high, and settlement systems are archaic. Tokenization compresses those frictions, enabling secondary markets for assets that previously had none. Imagine a world where infrastructure projects, fine art, renewable energy portfolios, or intellectual property royalties can trade as seamlessly as equities 24/7 globally with transparent records. That is the future being built right now, one token at a time. The implications for capital allocation are transformative. As tokenized markets mature, price discovery becomes more accurate, capital flows more efficiently to innovation, and investors gain more diversified exposure. The historical asymmetry, where institutions thrived on privileged access, is narrowing. In its place, a more open, meritocratic system is emerging, where returns are determined by insight and conviction rather than connections and gatekeepers. This is how innovation reshapes finance, by aligning incentives across all participants in the wealth creation process. What we are witnessing is not the digitization of finance, it is the decentralization of it. The power is shifting from a concentrated few to a distributed many. Tokenization is not about replacing existing systems. It is about upgrading them for an age of transparency and inclusion. Regulators, institutions, and innovators are beginning to converge on this vision, developing standards that balance accessibility with accountability. In the process, global capital markets are becoming more integrated, resilient, and equitable. This democratization of access will likely accelerate in the coming years as infrastructure matures, regulation adapts, and investor education spreads. The next generation will not think of investing as a privilege. It will be a native function of the digital economy. Value will move as freely as information does today. In that world, ownership is no longer static. It is dynamic, fractional, and global. The boundaries that once separated institutional and individual wealth are dissolving. The great unlock of the 21st century is happening, not just in technology, but in access to wealth itself. We are entering an age where the stability investors once took for granted is being redefined. The global economy is undergoing a structural reset, driven by demographic shifts, energy transitions, deglobalization, and technological disruption. In this landscape, the need for resilience has never been greater. The traditional tools of portfolio defense, such as fixed income and cash, are losing their reliability as hedges against inflation and systemic instability. This is why real assets, those with intrinsic, tangible value, are regaining prominence. They have become not just stores of wealth, but strategic instruments for navigating the volatility of a rapidly changing world. For decades, low inflation and declining interest rates created an environment where financial assets thrived. The cost of capital was artificially suppressed, and leverage became the engine of growth. That era has ended. The global economy is now contending with new sources of inflation, not cyclical, but structural. The reshoring of supply chains, rising labor costs, the massive capital investment required for the energy transition, and geopolitical fragmentation are all contributing to sustained upward pressure on prices. Inflation in this new form is not an event, it is a condition, and within that condition, real assets have reemerged as the cornerstone of wealth preservation and long-term value creation. Real assets such as infrastructure, real estate, commodities, and natural resources possess qualities that digital or financial instruments cannot replicate. They are finite, functional, and essential to human progress. When the value of money fluctuates, when markets convulse, real assets continue to serve their purpose. They generate utility, yield, and cash flow grounded in necessity. That is their strength. They are tethered to the physical and operational backbone of the global economy, the grids that power cities, the logistics networks that move goods, the housing that sustains populations. In an inflationary world, these assets adjust with prices rather than erode under them. But this is not a simple return to old-world asset ownership. The new wave of real assets is being redefined by technology and sustainability. Infrastructure is evolving from static to intelligence. Smart grids, renewable energy systems, and digital connectivity projects that combine tangible value with scalable innovation. Real estate, too, is being transformed by data, automation, and changing patterns of work and consumption. These modern real assets offer both stability and adaptability, combining the durability of the physical with the growth potential of the digital. This hybrid nature is what makes them essential in a world where inflation and innovation coexist. Moreover, the shift toward real assets represents a deeper recognition of how capital must adapt to systemic change. The global financial system is increasingly exposed to fragility from debt saturation and financial engineering. Real assets, by contrast, anchor portfolios in productive value. They align capital with real economic output and infrastructure needs, offering returns that are not purely speculative but grounded in long-term utility. Institutional investors are responding, allocating more to infrastructure, private credit, and energy transition projects as strategic hedges against both inflation and financial system volatility. This is not a defensive retreat, it is a proactive repositioning toward resilience. Another dynamic driving the importance of real assets is the evolution of monetary policy itself. As governments run persistent deficits and debt burdens rise, the temptation to inflate away obligations grows. In such an environment, nominal asset values may rise, but real purchasing power declines. Real assets, however, are anchored to physical scarcity and real-world demand. They retain intrinsic worth when currencies are diluted. This makes them not only hedges against inflation, but also against the erosion of confidence in fiat systems. In a world of monetary experimentation and fiscal expansion, that attribute is invaluable. Energy transition is another major catalyst. As the global economy shifts from fossil fuels to renewables, capital expenditures on infrastructure, storage, and supply chains are accelerating. These projects represent long-term cash flow, generating assets that are directly linked to structural change. They serve as inflation hedges not because they resist change, but because they enable it. The capital that flows into sustainable infrastructure, advanced materials, and clean technology is not just protecting purchasing power, it is building the foundation for the next industrial era. In essence, real assets are becoming the new core of strategic allocation. They are not merely defensive tools, but proactive enablers of stability, income, and innovation. The portfolios of the future will blend tangible assets with technological leverage, reflecting a world where physical and digital value coexist and reinforce each other. In an era defined by uncertainty, scarcity, and transformation, real assets are the anchor in the storm, the bridge between enduring value and the future that is being built before our eyes. A profound reordering of capital is underway. The digital revolution has expanded beyond technology. It is now transforming the very concept of what constitutes an asset. For decades, wealth was defined by ownership of tangible or regulated financial instruments, equities, bonds, and real estate. But in the emerging economy, value is being created, stored, and exchanged in entirely new ways. Digital and alternative assets are not speculative anomalies, they are strategic pillars of a new financial architecture, one that aligns with the decentralization, transparency, and exponential innovation reshaping the global system. The rise of digital assets reflects an evolution in trust. Historically, we relied on institutions to verify ownership, manage transactions, and preserve value. Today, that trust is being redefined through code, cryptography, and distributed consensus. Blockchain technology is not just a financial innovation. It is a technological foundation for a global transfer of value as seamless as the transfer of information. This shift is as consequential as the birth of the Internet itself. Just as the Internet democratized access to knowledge, blockchain is democratizing access to capital and ownership, the assets built on it, whether cryptocurrencies, tokenized securities, or digital representations of real-world value are forming the connective tissue of the next global economy. Digital assets are evolving beyond their early narratives. What once was dismissed as speculative has now become infrastructural. Stablecoins facilitate instant global payments. Decentralized finance DeFi enables peer-to-peer lending, borrowing, and yield generation without intermediaries. And tokenized assets are bridging traditional finance with digital liquidity. This ecosystem is no longer a niche, it's a rapidly growing parallel system, attracting institutional capital, regulatory frameworks, and global adoption. For investors, this represents a generational opportunity, exposure to an entirely new asset class that is uncorrelated with legacy systems, yet increasingly essential to their future. Beyond blockchain, alternative assets, venture capital, private equity, hedge strategies, art, collectibles, and intellectual property are gaining strategic importance as the public markets become saturated and predictable. The traditional equity markets are dominated by mega-cap incumbents, limiting access to early-stage innovation where the most exponential value is created. Private markets, in contrast, are the breeding grounds of disruption. This is where technological revolutions begin, where the cost declines and productivity gains that redefine industries are born. Allocating capital here is not about chasing returns. It is about participating in the creation of the future itself. Institutional and high-net worth investors have already begun to pivot toward this structure. Family offices and endowments are significantly increasing their exposure to alternatives, often exceeding 50% of portfolios. Their rationale is strategic. Alternatives provide diversification, inflation protection, and exposure to long-term innovation cycles that traditional markets cannot replicate. As private and digital markets integrate, the lines between these asset classes are blurring. Tokenization will make private assets more liquid, accessible, and transparent, fusing the efficiency of digital systems with the growth potential of private capital. The result will be a new hybrid market, part physical, part digital, where ownership and liquidity coexist seamlessly. At the same time, digital assets are becoming macro-relevant. In a world of persistent debt expansion, currency debasement, and geopolitical fragmentation, assets that operate independently of traditional systems are increasingly viewed as strategic hedges. Digital stores of value, built on scarcity, transparency, and mathematical certainty, are emerging as complements, not competitors, to traditional safe havens. They provide optionality in a system where monetary policy can shift overnight, and where the value of trust itself is being redefined. For forward-looking investors, exposure to such assets is no longer an experiment. It is prudent diversification. The convergence of technology, finance, and decentralization is giving rise to a new ecosystem of wealth creation, one where innovation, access, and transparency are foundational. The global financial map is being redrawn around these principles. In this new order, digital and alternative assets are not just portfolio enhancements. They are essential building blocks of resilience and growth. The investors who recognize this shift early, who align with it through thoughtful allocation and conviction in technological progress, will be the ones who capture the compounding effects of a digital financial future. In a world moving at exponential speed, standing still is the riskiest strategy of all.